Hi, I'm Pete Andresen with Andresen and Associates, and it has been an interesting week. Essentially, especially today, what's been happening is the yield curve, that's the difference between short-term rates and long-term rates for longer-term bonds, which determines things like mortgages, has been really getting torqued in the last week. And I know, most of our money is made in the long run in the stock market, but the bond market is probably the thing that gives the stock markets permission to do what the stock markets do. And what's happened is people have started to realize after the Federal Reserve moved its lips that the Federal Reserve may keep longer rates higher longer than expected. As you know, the soft landing concept and the lower long interest rates were based on the premise that this couldn't last. It wouldn't last very long at all. And then we go back to zero interest rates. That was never going to happen. It finally caught up with the stock market investors and the bond market investors. So what's happened is a major spike in the yield of long-term bonds, long-term treasuries, long-term everything bonds. And that's going to result in long-term mortgages. It's also going to result in an interesting problem because a lot of real estate debt, especially in commercial real estate, is going to come due in the next year or so. Meanwhile, we've been expecting it, haven't we? That's why I stayed in short-term maturities for 5 years. And there we were stuck in those short-term maturities because I was waiting for that to happen. Well, now it's happening. On the 10-year Treasury, yields hit 5%. Think about that. You can now buy a 10-year Treasury and get 5% per year, essentially risk-free. As those are the highest rates since 2007. What happened after 2007, I wonder? And a lot of that happened with refinancing becoming an issue with mortgages. Now we don't have the same problem with mortgages. We got problems with commercial real estate, which is frankly less of a existential problem for the American consumer. So longer rates, I'm trying with our portfolios to creep into longer term bonds, longer term bond ETFs, longer term bond mutual funds. And so far I haven't found the bottom, have I? It's continued to, bonds have continued to decline. 30-year treasuries are down about 50% now. We have short-term losses on anything I did in the last week, but they're not big. They're tiny. It's always a blow to my ego to try to find that bottom, to catch that falling knife, and of course I get cut a little bit as I grab for it. Now, a couple of things. The first thing is that this reminds me a great deal of 1987. Where rising interest rates finally tipped the stock market. And that was a real whiz-bang, over 30% in a day or so. That won't happen because of trading restrictions. It's also unlikely, almost impossible economically, for this thing to go to 10% or something like that. There's too much debt to refinance. The economy will tip over before then. So I still believe that long-term bonds are now offering us a bargain. I still intend to take it gradually. As you know, I'm always a little early, so I'm trying to slow myself down. The final comment here is that it paid to be patient, and we're doing the right thing. And right now, the soft landing concept is going to come under stress after this interest rate goes up and stays up. So we're having a very interesting time. At least we're not bored. Remember, diversification pays. It can pay for decades. Take care, enjoy fall, and blessings.